Technical analysis in 10 minutes, finding clues in the stock market. This tutorial is for beginners who want a quick grasp of technical analysis, the art of understanding market behavior by studying past price and volume data. Through this video, you'll learn 1. What is technical analysis? 2. How to read charts and identify trading signals. 3. Resources for learning and refining your TA skills. 4. Exploring the effectiveness of TA in real-world trading. So, at first, let us know what is technical analysis. Technical analysis is nothing but to follow the smart money. Imagine detectives searching for clues left behind by murderer. Similarly, TA practitioners identify the actions of large investors, known as smart money, in their quest for trading opportunities. These institutional players leave subtle but telling footprints in the form of price and volume movements. Skilled TA analysts decipher these clues to inform their trading decisions. Not all technical analysts follow the smart money in similar fashion. Smart monies are super secret. They announce their trading position only before distribution. Let us give you a real-life example. This is the screen of DSE mobile app. We do trade using this application. Remember fortune shoes trading within a narrow range at 22 to 24 Taka? TA identified smart money entering the stock, prompting us to follow suit near 24. When the news finally broke about a large fund's position, pushing the price to 95 to 96, we secured a 300% profit by strategically exiting. Whenever we talk about analysis, then different graphs spring to our mind. In the graph, we can see different past prices in different days. However, stock is not always traded in same price in a single day. Price varies in different times in same day. While a line chart simply shows past prices, candlestick charts reveal the intricate dance of price fluctuations throughout the day. Red candles represent falling prices, while green signify rises. Understanding these formations is crucial for interpreting market sentiment. At the beginning of this training, first we will get to know how these sticks are formed. At the left side of the screen, you see the trading price at different times. We can see the ups and downs of the screen in the middle of the screen with the change of price. A red box is being created when the price decreases from Taka 18.9 and a green box is being created when price increases from Taka 18.9. This 18.9 Taka is the opening price. That means today's first trade took place at Taka 18.9. Sell pressure causes the fall of the price, and buy pressure causes the rise of price. More the buy pressure, longer the green box is. In technical analysis, it is called candlestick because it looks like a candle. So with this candlestick pattern, we can say that price increased significantly from its opening price. However, because of sell pressure, price finally decreased. Conversely, this pattern with a slight dip from its opening price followed by a substantial increase due to strong buying pressure signals potential bullish momentum. The initial dip might be a buying opportunity for traders anticipating an upward trend. So from different candlestick pattern, one can get idea about trading price of a certain stock in certain period. Those who can read the market well with the help of candlestick can predict market well. Here we just learned two different types of candlestick patterns. Every day's trading throws up new candlestick patterns, just like different strokes paint different pictures. Here are a few examples. Seeing one of these on the chart can be a clue about what the price might do next, with some patterns hinting at upticks and others suggesting potential drops. However, don't get too fancy thinking these patterns guarantee a price skyrocket or nosedive every time. Where they show up on the chart matters a ton. Imagine a stock getting pummeled by selling for 3 days straight. On day 4, it shoots up like a rocket, showing there were super strong buyers waiting in the wings. That's what technical analysts keep their eyes peeled for, whether a price is bouncing back from a beat down. So, the stock price starts climbing, right? Boom, the analysts see their chance to cash in. They snap up all they can, hoping to score big bucks soon. But hold on, after all that pumping, the price suddenly nosedives. Oh, the analysts get spooked. They think the whole thing might be crashing down, but they're not taking any risks yet. They gotta see for sure if this is just a bump in the road or the end of the party. So, they sit tight and wait for the next clue. Same pattern, different meaning depending on where it hangs out on the chart. That's why they gotta stare at those squiggly lines all day. Gotta read the whole story, not just the headline. Imagine the price of a stock like a climber trying to scale a mountain. Every now and then, it hits a wall where it just can't seem to climb any higher, like there's some invisible force pushing it back down. Technical analysts call those walls resistance levels, and they're like super sleuths watching for them. So, when these sleuths see a stock get stopped cold at a certain level, they figure it'll probably get stuck there again next time. That's when they get clever. They buy the stock when it's down by the base of the mountain, then just chill and wait for it to bounce back up to that resistance level. Boom. Easy profit for our clever sleuths, who then sell the stock and watch it roll back down the mountain. Sneaky, huh? Remember, these resistance levels aren't like magic walls, but they're a pretty good hint of where a stock might get stuck. And just like any good detective, technical analysts gotta pay attention to all the clues to make the right call. Analysts also sometimes notice that share price could not go further below at certain level. Price bounced back from that level. Technical analysts call this level a support level. Therefore, market frequently give opportunity to make profit if someone can buy at this support level. Remember those resistance and support zones we talked about? Turns out, there's even more detective work to be done on these charts. There are special patterns that show up like wrinkles on the graph, and they often give clues about where the price might head next. See that pointy-haired guy with the arrow? That's a pattern, and Mr. Arrow is pointing up, saying the price might climb after it shows up. So, smart analysts see Mr. Arrow and his buddies, then scoop up some shares, hoping the price takes the elevator up like promised. But wait, there's more. These analysts have secret tools called indicators, like that blue and red squiggly line dance going on here. When the blue line does a victory lap over the red one, boom, the price often takes off. This fancy dance is called MACD, and it's like a cheerleader for the price. Lots of other indicators exist, each singing a different tune about what the price might do. Remember, though, these patterns and indicators aren't crystal balls. They just whisper probabilities in the analyst's ears. But hey, even a small tip about the market's mood can help you score some sweet profits. So where can you learn to tango with these charts and secret indicators? Well, you could totally Google each thingy we mentioned, one by one. But if you want to go full-on market ninja, there's this fancy exam called the CMT that makes you a globally recognized capital market technician. And hey, if you ever get stuck figuring out those squiggly lines, feel free to reach out. We're always happy to help a fellow market explorer. Now, let's see some real-life wins using this technical analysis magic. Check out this screen. It's like a time capsule of a successful trade on the Dhaka Stock Exchange. Pretty cool, right? If you dug this tutorial, please share it. Sharing is caring, and knowledge is power. And thanks for hanging with us.